What is going on, guys? Nick here, back with another video. We are in the middle of a pretty serious bear market right now, and myself, probably just like most of everybody watching this video, has been creamed pretty good this year. Now, for some of you guys, especially those who joined during the COVID crash and during GameStop madness, you probably haven't experienced an actual market sell-off before. They keep saying to buy the dip, but it just keeps on dipping. So some of you no doubt have gone into defensive mode, either selling out all of your stocks and leaving the stock market. Actually, now that I think about that a little bit more, you guys probably aren't watching this video. And I've seen a lot of others talk about getting into defensive stocks, buying mature stocks with sometimes limited upside. In all seriousness, if you did buy heavily into growth stocks in 2021 and then the market sold off and you panicked and you sold them all, and now you're getting heavily into defensive stocks with little upside, you're kind of doing the real life meme equivalent of bulls make money, bears make money, and pigs get slaughtered. To those of you who are just going into these defensive stocks, I would actually recommend that you get more into the S&P 500 index funds like VOO or SPY rather than a bunch of low growth mature stocks that pay, a 3 to 5% dividend. But all of that depends on your situation, and if you're close to retirement, that might not make that much sense. The rest of you have hopefully held on to your convictions and still believe what you bought into and are waiting for the bear storm to blow over. And that last option is great. That's what I'm doing myself, and that's not going to change anytime soon. However, just because it traded at a really high price last year, that does not necessarily mean that the stock is going to trade at that price sometime in the near future. Some of those stocks were way too expensive when you bought them at the time, and they're just not going to recover, unfortunately. So for those of you who haven't sold out yet or still have a few stocks that you're holding on to, I'm going to show you guys how you can tell if the stock is going to rebound and if it's worthwhile hanging on to it. Now, there's going to be a lot of factors that put pressure on stocks for the rest of the year. Quantitative tightening, where the Fed is offloading trillions of dollars in assets that it bought between 2020 and 2021. On top of that, rate hikes that are probably going to occur all the way through the summer and pretty much guarantee that the economy is going to have to slow down. I find it really hard to believe that the soft landing that's been talked about is really possible here. I just don't see how the Fed is going to be able to continue to raise interest rates in a high inflation environment with an incredibly tight labor market at below 4% unemployment without experiencing some sort of recession, but I'm not a fortune teller, so we're going to have to see what happens. But setting all of that aside, what you really need to consider is the company that you've invested your hard-earned money into. And I know, mind-blowing stuff here, but it's just insane to me how many people take their hard-earned money and are essentially writing blank checks, assuming that the price the last guy paid for the stock must be a fair price, and that if the business is good, then the stock has to go up. Now, there are a lot of people who make this really confusing with a lot of really complicated accounting breakdowns, complicated discount cash flow models with a lot of fancy inputs. Fundamental analysis is really not that complicated. In all seriousness, unless there's a really weird situation going on, for a lot of companies, you can kind of figure out roughly what they should be worth in about 10 to 20 minutes worth of looking. So for years, what I've done is correlated future growth with the PE ratio that I think the company should trade at. I don't care about the industry average, what similar companies have traded at, or how expensive or cheap something looks in comparison to its trailing earnings. An estimation of future growth is what justifies what price you should be paying for a stock today. Let's say you have a company that's going to grow 0% over the next 10 years. And let's say that company earns $1 per year. That company, doing some simple math, is obviously going to generate about $10 over the next 10 years. But now, because I'm not going to pay $10 today to earn $10 10 years from now, what I need to do is subtract, or discount as you might have heard other people say, the risk-free rate, or in other words, the rate that I could safely invest my money somewhere else. For this, the 10-year treasury bond is a really common calculation, and after a really quick Google search, that sits at about 3% today. So a growth rate of 0% using this formula that I've used for a long time, which by the way is linked in the description below if you want to check it out for yourself, the company would be worth about $7.34. And I say about because value is not something that's written in stone. You should consider value a general estimate and not necessarily an exact amount. But how exactly do you come up with this growth rate? Well, great question. And this is kind of the art of the whole thing. So the way I used to do it was to go to Morningstar.com, hit the key ratios tab, and then scroll down to this great little growth tab here at the bottom. it shows the revenue growth year over year, the 3-year, the 5-year, and the 10-year, and then the same thing for the operating income growth, the net income growth, and the earnings per share growth. Now, that has been a fantastic tool that I've used for years, but very sad to me, that tool is apparently about to be retired sometime soon, and that makes me very sad. So in the future, I'm probably going to pull this information from macrotrends.net, which seems to have similar information. But for now, let's continue on with Morningstar.com. I'm going to show you guys a pretty easy one just so you can get a quick understanding of what we're looking for here. So here's the growth tab for Google. The revenue growth, if we look at the past 10, 5, and 3 years, all shows low 20% growth rates. Net income growth is around 22% for the 10-year and 31% for the 5-year. And the earnings per share growth shows 22% for the 10-year and 32% for the 5-year. Sometimes this earnings per share number can grow a little bit faster than the rest of the segments because the companies buy back their stock, and when that happens, the rest of the shares will now represent a slightly larger piece of the entire company. Now, where I think a lot of people get this a little messed up is they fail to look at the forecasted earnings. Now, obviously, you can't treat these as if they're written in stone because they haven't happened yet and these are only forecasts. But I do find that they tend to be pretty reliable, or at least more reliable than estimates that I could come up with on my own. Now, a really easy way to find this is to just go over to Seeking Alpha, and right here you see there's this nice little table that shows all of the earnings estimates. I pretty much just copy and paste this info together so I can see it all at once. So here Google shows using year-over-year growth, the next few years only project to grow about 13 to 15% revenue growth, so much lower than what we were seeing in the past. Also, by using this graph, we can see that there was a huge spike in growth, so that probably did distort our final number a little bit, so that 20% growth probably isn't that realistic for Google going forward. Now, we can also look at the net income growth, and we can see 2022 is supposed to show negative growth, but 2023 and 2024 show 18 and 14% growth. So I think to value Google, we should use a growth rate between 13% and 17%, just to be a little on the safe side. Well, I put these numbers into my PE calculator, which gave me a fair PE range between 25 and 37. Now, you can just multiply these numbers by the earnings per share, and that puts Google's value between $2,700 to about $4,000 per share right now. And that only gets better, with 2024 showing about $3,800 to $5,500 by 2024. So with the stock this undervalued right now, Google is of course no surprise a bounce back candidate. But I think most of us probably expected that. Now, Netflix on the other hand has fallen an insane amount, going from about $700 per share to about $200 in about 6 months. Now, looking at Netflix's growth tab, pretty much everything was around 25% growth or higher over the last 10 years. So there's probably some people out there who would say that this is a great growth company, and because they went from about $700 per share to about $200 per share, this has to mean that the stock is undervalued, right? Well, when we look at the forecasted revenue growth, it's pretty much projected to remain around 10% going forward. And when we look at net income growth, things look a little bit better at about 13 to 20%. However, there's only 4 analysts projecting out this far, and there's 30 analysts projecting this year-end number, so I'm a little skeptical of this 20% in 2024. So for Netflix, I'm going to stick with a growth rate between 10 to 13%. So 10 to 13% growth comes out to a fair PE range between 19 and 26. So when we multiply the earnings estimates times the PE ratios that the company should trade at going forward, you can see that the stock probably is a little undervalued right now. But if you bought in somewhere in the 5 to 600s, you probably paid way too much for the stock. And I don't see it coming back to those levels anytime soon. I think for a long time that Netflix price seemed to reflect more growth than I expected it would be capable of. And I think that's starting to show with the subscriber count issues, and now Netflix really scraping the bottom of the barrel, looking to clamp down on password sharing and putting ads on the platform just to grow, and I just don't see the growth that we saw in the past coming back for Netflix. Now, if you have been holding Netflix stock, I'm not 100% sure that I would recommend selling here at this point. The truth is the stock does actually have some upside from the current price, but I absolutely would not blame you if you just wanted to move on and forget about Netflix. So how do you tell if your account is going to recover when the bear storm blows over? Well, the financials will tell it all. All of these larger economic issues and moves from the Fed are going to continue to put pressure on stocks. But all of this that we're going through right now is a long-term buying opportunity. Good businesses with products that people like, who manage their finances well, will be just fine through all of this. And if you bought stocks at high prices last year, I would just recommend looking at the current price today, figuring out roughly what the company should be worth over the next couple of years, and deciding whether or not there's still enough upside for you to continue holding. If you decide that it's not worth it and you sell that stock, you're still going to have to invest that money elsewhere. And as always, thanks for watching. Oh, also, new camera. If you guys are still watching at this point, comment below, tell me if you like it. And for real, for staying all the way to the end, thank you for watching.